Did you know that the UK government has just made a decision that could change everything about when you retire? Forget everything you thought you knew about retirement age, because what I'm about to share with you today is absolutely groundbreaking. Whether you're in your 50s, 60s, or already collecting your pension, this information could dramatically impact your financial future. Stay with me because by the end of this video, you'll understand exactly what these new rules mean for you and how to make the most of them. I'm going to break down the shocking changes to UK pension rules in 2025 that nobody is really talking about yet. Welcome back to Senior Secure UK, where we cut through the confusion and bring you the essential information you need to secure your financial future. I'm your host, and today we're diving deep into one of the most significant changes to UK pension policy in decades. If you're new here, make sure you hit that subscribe button and turn on notifications, because we regularly share crucial updates about pensions, benefits, and retirement planning that could save you thousands of pounds. So let's get straight into it. What exactly has changed, and why is everyone calling this shocking? The UK government has introduced sweeping reforms to pension rules for 2025, and one of the most dramatic aspects is the effective abolition of a mandatory retirement age for most workers. Now, before you think this is just another boring policy change, let me explain why this matters enormously to millions of people across the country. Historically, the UK had what was known as a default retirement age of 65. This was scrapped back in 2011, but what we're seeing now in 2025 goes much further. The new rules create an entirely flexible framework that fundamentally changes how we think about retirement, when we can access our pensions, and how we plan for our later years. The government has essentially said that there is no longer any expectation or standard age at which people should retire, and they've backed this up with significant changes to how pensions work. Let me break down the key changes one by one so you can fully understand what this means for your situation. First and foremost, the state pension age remains at 66 for now, but the trajectory for future increases has been modified. Previously, the state pension age was set to rise to 67 between 2026 and 2028, and then to 68 by the mid-2040s. The new rules have introduced a more flexible approach to this timeline, with regular reviews every 5 years instead of the previous 6-year cycle. This means the government will be constantly assessing life expectancy data, economic conditions, and workforce participation before making changes. But here's where it gets really interesting. While the state pension age remains the earliest you can claim your state pension, the rules around private and workplace pensions have become significantly more flexible. Under the new 2025 regulations, individuals can now access their private pension pots from age 55, which actually remains unchanged from current rules. But what has changed is how you can take that money and the tax implications around it. The minimum pension age is scheduled to rise to 57 in 2028, but the new rules have introduced something called graduated access. This means that instead of having to wait until 57 to access any of your pension, you can now access up to 25% of your pension pot from age 55 for specific purposes, including retraining, caring responsibilities, or starting a business. This is a huge shift that recognizes the changing nature of work and life in the 21st century. Another massive change is to the annual allowance, which is the amount you can contribute to your pension each year while still receiving tax relief. The annual allowance has been increased from £40,000 to £60,000 for the 2025 tax year. This is a substantial increase that allows higher earners and those playing catch-up with their pension savings to put away significantly more money in a tax-efficient manner. For basic rate taxpayers, this means you get 20% tax relief on contributions, while higher rate taxpayers get 40%, and additional rate taxpayers get 45% relief. The lifetime allowance, which was the total amount you could save into pensions over your lifetime before facing additional tax charges, was already abolished in the 2023-2024 tax year, and this remains the case. However, the new 2025 rules have introduced clearer guidance on how large pension pots are taxed when you start taking money out. The key point here is that while there's no limit on what you can save, the way you withdraw money and the tax you pay on it has been streamlined to make it more predictable. Now let's talk about one of the most controversial aspects of these new rules: the removal of any expectation around retirement age for workers. What this means in practical terms is that employers cannot force you to retire at a certain age unless they can objectively justify it. The burden of proof is now heavily on employers to demonstrate why a specific retirement age is necessary for a particular role. This might apply to jobs with significant physical demands or safety-critical positions, but for the vast majority of office-based and service sector jobs, there is now no age at which you must stop working. This creates enormous flexibility for older workers who want to continue earning, whether that's for financial reasons, to stay active and engaged, or simply because they love what they do. However, it also raises questions about workplace dynamics, career progression for younger workers, and how businesses manage succession planning. The government has issued guidance to employers about managing an age-diverse workforce, but this is undoubtedly going to be a learning process for many organizations. One of the supporting changes that makes this more practical is the expansion of flexible working rights. Workers of any age can now request flexible working arrangements from day one of employment, and employers must consider these requests seriously. This includes part-time work, job sharing, compressed hours, and working from home. For older workers who might want to wind down gradually rather than stopping work completely, this is a game changer. You can now potentially negotiate a 3-day week, work from home more often, or take on a less demanding role without necessarily having to retire completely. The state pension system itself has also seen adjustments. The triple lock, which guarantees that the state pension increases each year by whichever is highest out of inflation, average earnings growth, or 2.5%, remains in place for now. However, the new rules have introduced what's being called the fairness adjustment. This means that people who continue working beyond state pension age and defer claiming their state pension will see enhanced increases to their eventual pension payment. The deferral rate has been improved, making it more attractive financially to delay claiming if you're still earning a good income. Let's talk about what this means for your tax situation, because this is where many people get confused. If you're working beyond state pension age, you no longer pay national insurance contributions, which is a significant saving. However, you still pay income tax on your earnings. If you're also drawing a private pension while working, both your salary and your pension income are added together for tax purposes, which could push you into a higher tax bracket. This is something you need to plan for carefully. The new rules have also introduced a pension advice allowance. Every individual over the age of 50 can now access up to 3 free pension advice sessions with a qualified financial advisor, funded through a government scheme. This is designed to help people navigate these complex new rules and make informed decisions about when to retire, how to access their pension, and how to manage their money in retirement. I cannot stress enough how valuable this could be, especially if your pension situation is complicated with multiple pension pots, or if you're unsure about the best strategy for your circumstances. For those of you with defined benefit pensions, often called final salary pensions, the changes are somewhat different. These pensions typically have a normal retirement age built into the scheme rules, often 60 or 65. The new legislation doesn't override these scheme-specific rules, but it does require schemes to offer more flexibility around when and how you take your pension. Most defined benefit schemes now have to offer options for taking your pension early with a reduction, deferring it for an increase, or drawing it flexibly while you continue working part-time. One area that has seen significant change is pension protection for carers. If you take time out of work to care for elderly parents, a disabled spouse, or grandchildren, you can now receive credits toward your state pension automatically, without needing to claim carer's allowance. This addresses a major gap that previously left many people, particularly women, with reduced state pensions because of caring responsibilities. The system now recognizes unpaid care work much more comprehensively. The rules around pension death benefits have also been updated. Previously, if you died before age 75 with money remaining in your pension pot, your beneficiaries could inherit it tax-free. If you died after 75, they paid income tax on withdrawals. The new rules have simplified this, so that beneficiaries always pay income tax on inherited pension money at their marginal rate, but the threshold has been raised, and there are new allowances that reduce the tax burden for smaller inherited amounts. This makes the system fairer and more predictable. What about auto-enrollment? The Workplace Pension Auto-Enrollment Scheme has been a huge success in getting millions more people saving for retirement. The new rules extend auto-enrollment to workers from age 18 instead of 22, and they also remove the lower earnings threshold. Previously, you only earned pension contributions on earnings above a certain amount, but now contributions are calculated on your entire salary from the first pound you earn. This might seem like a small technical change, but it makes a real difference to lifetime pension savings, especially for lower earners and those working part-time. Employer contribution rates have also been addressed in the new rules. While the minimum employer contribution remains at 3% of qualifying earnings, there is now a strong expectation that employers will review their pension contributions regularly and increase them where possible. Large employers with over 250 employees must now publish annual reports on their pension provision and how it compares to industry standards. This transparency is designed to create competitive pressure for better pension benefits. For self-employed workers, who have historically had lower pension participation rates, the new rules introduce an auto-enrollment style scheme. If you're registered as self-employed and earning over a certain threshold, you'll be automatically enrolled in a personal pension scheme with the option to opt out. The government will provide a matching contribution up to a certain level, essentially creating a system closer to what employed workers enjoy. This could make a massive difference to retirement outcomes for the millions of self-employed people in the UK. Now, I know what some of you are thinking. This all sounds complicated, and how do I actually make this work for me? Let me give you some practical strategies based on these new rules. If you're in your 50s and still working, the increased annual allowance means you should seriously consider maximizing your pension contributions, especially if you're a higher rate taxpayer. The tax relief essentially gives you free money, and with the lifetime allowance gone, there's no penalty for building up a large pension pot. If you're approaching state pension age but still enjoying your job and earning well, it might make financial sense to defer claiming your state pension. The enhanced deferral rates mean you could get a significantly higher pension later, and in the meantime, you're not paying national insurance on your earnings. Run the numbers with a financial advisor to see if this strategy works for you. For those of you who are already retired but finding money tight, the flexibility to return to work without losing your state pension makes this much more viable. You could take on part-time work, consultancy, or freelance roles to supplement your pension income without complex rules about earnings limits. If you have multiple pension pots from different jobs over the years, now is the time to consolidate them. The new rules make it easier to transfer pensions and combine them into a single pot where you have better visibility and potentially lower fees. Just be careful with defined benefit pensions, as transferring these is rarely a good idea without specialist advice. One strategy that's becoming increasingly popular under the new rules is phased retirement. Instead of working full-time until a specific age and then stopping completely, you can gradually reduce your hours while starting to draw down your private pension. This gives you the best of both worlds: continuing income from work, supplemented by pension withdrawals, while giving you more time for leisure, family, and personal interests. The flexible working rules support this approach by making it easier to negotiate reduced hours with your employer. The removal of any mandatory retirement age also means you need to think more deliberately about when you actually want to stop working. Without a default age pushing you toward a decision, it's important to consider your health, your financial needs, your enjoyment of work, and what you want to do with your time. Some people find great satisfaction in work and want to continue as long as possible. Others can't wait to retire and pursue other interests. There's no right answer, but the new rules give you the freedom to make that choice based on your personal circumstances rather than arbitrary age limits. So what should you do right now to make the most of these changes? First, take stock of your current pension situation. Track down all your pension pots, understand how much you've saved, and project what income that might give you in retirement. There are free online calculators that can help with this, or you can use one of those free advice sessions I mentioned earlier. Second, review your current pension contributions. With the increased annual allowance, could you afford to pay in more, especially if you're a higher rate taxpayer? Even an extra £100 a month could make a significant difference over time, thanks to compound growth and tax relief. Third, think about your ideal retirement timeline and lifestyle. When would you like to stop working, or would you prefer to wind down gradually? What do you want to do in retirement, and how much will that cost? Having a clear vision helps you plan properly. Fourth, talk to your employer about flexible working options if you're thinking about phased retirement. Many employers are open to these conversations, but you need to initiate them early, ideally a couple of years before you're thinking of making changes. Finally, don't try to figure all this out alone. Take advantage of that free pension advice, speak to financial advisors, and use the resources available from organizations like the Money and Pensions Service. These decisions are too important to get wrong. The bottom line is that the UK pension landscape has changed dramatically in 2025. The abolition of any mandatory retirement age, combined with more flexible access to pension savings, increased contribution limits, and better support for diverse working patterns, creates unprecedented freedom in how you plan your later years. But with this freedom comes responsibility. You need to engage with these rules, understand how they apply to your situation, and make active choices rather than just drifting toward retirement. So there you have it, a comprehensive breakdown of the shocking new UK pension rules for 2025. I hope this has helped you understand what's changed and how it might affect you. Remember, knowledge is power when it comes to your financial future, and staying informed about these changes is the first step toward making smart decisions. If you found this video helpful, please give it a thumbs up and share it with friends or family who might benefit from this information. Drop a comment below and let me know your thoughts on these new rules. Are you planning to work longer, retire early, or somewhere in between? I read every comment and love hearing about your experiences. Don't forget to subscribe to Senior Secure UK if you haven't already. Hit that bell icon so you never miss our updates on pensions, benefits, and everything that affects your financial security. We're here to help you navigate these complicated systems and make informed decisions about your future. Thank you so much for watching today. I'll see you in the next video where we'll be diving into how to maximize your state pension payments. Until then, take care, stay informed, and remember that your financial future is in your hands. This is Senior Secure UK, helping you secure the retirement you deserve.